Hey, Dennis Tubbergen here with another economic update. It's March 1, 2018, the first day of March. I want to share with you today in the economic update something from Bill Bonner with Bonner and Partners. You can go check it out for yourself at bonnerandpartners.com. I've got the webpage up on the screen. And Bill just writes this: buy the dip has worked for 38 years, and now investors are more than 100% convinced it will work again. He says, but they are wrong. And his rationale is very interesting. He shares an extract from a letter to clients of Semper Augustus, which is an investment group. The letter said this: fundamental investors like to pronounce they don't think about macroeconomics. It's all about researching companies, they say. We're with you, brothers and sisters. However, if there was one economic chart to pay attention to, the one presented below of the changes in the Fed's discount rate is it. Every major stock market decline and every recession in the last 100 years was preceded by the Federal Reserve raising short-term interest rates enough to provide the pin to prick the balloon. Now this chart goes back to the early 50s. The recessions are the gray areas on the chart, and notice that without exception, every one of these recessions was predicted by a rise in interest rates. Now, if you take a look at this end of the chart, we've had interest rates now just start to sneak up. Bill continues, note the emphasis on every. Yes, there have been periods where the Fed raised rates and a recession didn't ensue. Everyone knows the famous saying about the stock market having predicted 9 of the past 5 recessions. That may be true, that rising rates don't necessarily cause a recession, but as an investor, you must be aware that every major stock market decline has occurred on the heels of a tightening phase by the Fed. More importantly, there have been no substantive Fed tightening phases that did not end with a stock market decline. That is powerful. So when you take a look at where we are presently in this cycle, as I talked about on today's market analysis as well, you want to be aware of not only the technical setup of where stocks are, but you also want to be aware of some of these fundamental things. And it just really draws your attention to the fact that markets are very dependent on the actions of the Fed. In fact, I often point out what former Federal Reserve Bank, Dallas Federal Reserve Bank President Richard Fisher said in a CNBC interview several years ago. He indicated the Fed wanted to create a wealth effect, so they essentially dumped $1 trillion into the market and front-loaded a market rally. It appears that based on where we are technically and where we are fundamentally, that we may be nearing the end of this cycle, and you guys should all take appropriate steps if you're investing in stocks. That's today's economic update.